So guys, I have a very interesting stock to look at today, and I think it's a great option for many people for their style of investing, for safe investors, but not for the reasons that you think. So this is a very important video. I want you to stay and pay attention, especially when we get to the section about the share policy, to see why this is a great buy or potentially a great buy. I want to be careful when I say that. So check this out. We're going to go and look at PayPal right now. And I want you to pay attention to a few key things about how the market misprices assets and how the patient person, the patient investor, can make a lot of money because the market is the way it is. Because people react to news, or the market reacts to news and different things, but the market often overreacts. It creates opportunities for people who don't overreact to take advantage of it and make a lot of money. So let's get right into it. We have PayPal Holdings right now trading at $68.88 per share. Now check this out. Look at this significant downtrend here. I have my thing up. Let's look at this significant downtrend right here. I mean, it's a very sharp decline here. Very, very sharp, and pretty much flat ever since. So one thing I want you to know, and remember this as we go through this analysis, this is in 2021. The stock was trading at about $295 at its peak. In 2021, $295. 2025, $68. Now remember that. 2021, $295, 2025, $68. We're going to look at revenues and we're going to see how silly the market can be at times. Market cap 68 billion, beta of 1.5. So some volatility here, more sensitive than the market. Then we have a PE of 17. So not too expensive, not too cheap right now. We'll look at the revenues and the results of the company to give us more information there. Trading at about $3.99 per share, earnings per share. So let's get into it. Take a look at the revenues. 9.2 billion in 2015, all the way up to 31.7 billion. So one thing you got to see, each year they grew in double-digit growth up until 2021. Then the growth slowed significantly, 8, and 6. But check this out. Remember, $295 in 2021. They had 27.5 billion in revenue. Now it's 68. But they had 31. So they have more revenue now than they did before. But the thing is, the revenue did slow. So this what scared a lot of people away. Now, have they been that scared of this company to sell when the revenue slowed that much? I guess if you thought the revenue was going to continue to grow at 20% in perpetuity, which doesn't make sense. Growth is going to slow eventually. We see that growth starting to slow now. However, this company has a strong hold on their market. I don't see where there's danger here. So we'll go through the rest of the numbers and see margins continuing to grow. Each year it's better, or excuse me, 1 year it was down here. Sorry about that. But for the most part, 63, 50, and then margins are at about 46%. So margins did come down, and maybe this is why people ran away. But of course, it might have been way overvalued at $295 anyway. So this is what happens. The market overreacts. They think the company is going to continue to grow at this super high rate. Then when the reality sets in, they scram, then the valuations come down. This is why you don't rush to buy stocks. There's always going to be great opportunities in the future. Even with strong companies like PayPal, who would have thought they would have came down from $295 to $68? But that's where they are. And they've been flat for a few years. But let's look at the profitability. 1.2 billion to 4.1. So that net income did come down this year, and it's kind of spotty. It's up, always positive, but they had a few down years. 2022 down a lot. So net profit margin averaged at about 14.4%, 14.3 last year, 13 this year. So pretty close, a little bit down. So not the prettiest picture, but it's not bad at all. So let's go to the next section. Look at the free cash flow. Similar story as net profit as you would expect, 1.8 to 6.7. They had 1, 2, 3 years, 4 years where they've always had positive years, but you do have 4 years where the free cash flow went down from the year before. However, still trending up. It's still going up. They had this dip here, but 6.7, meaning they're above where they were. So the trend is continuing up, but it's not a smooth slope. It's some up and down. but that's okay because it's trending up. That's what we like to see in mature businesses. It's not going to be all rosy every year. Debt to free cash flow, great position. They can pay off their debt in less than 3 years. Didn't have any debt these years. 4.9 down to 9, up to 9.8 right now. 1.5 times free cash flow. If they get into trouble, they got to hurry up and pay off debt. They have enough cash flow to pay off their debt in a year and a half. Not bad at all. They are not paying a dividend. So this is the bread and butter of this video. Shares outstanding. So we typically don't see companies who are paying down their shares or buying back shares at this rate. That is a pretty steep drop. A little bit, moderate drop to 22, but from 22 to 23 to 24, it is a major drop. So this is very interesting to see. Now, as an investor, I see that the growth is there, but it's not very strong. I see that there's stability with their margins. I want to know, are they going to continue this trend? Because if they are, that's going to open up so much value for the shareholders. So let's take a look. So check this out. Last month, February 2025, the board approved $15 billion in share repurchases. Now, here's a great thing about that. It's boosting their current program to a total of $20 billion. They have $4.8 billion left from their commitment of 2022 to continue to buy back shares. That's why you see that big slope coming down, because they committed to spending billions on share repurchases, and they're doing so. So we love to see that. But they committed another 15 last month. They paid $6 billion in repurchases last year. They committed to paying another $6 billion this year. So for the next 3 years, it looks like there's going to be paying about $6 billion to repurchase shares, about $18 million for the next 3 years. And by that time, they might recommit more share buyback. So we'll see. So this is a lot of money for this company as far as repurchasing shares. This is one way that companies also add value to the shareholder. There's growing the business, there's paying a dividend, and there's repurchasing shares. This is a beautiful thing for long-term investors. So the share policy, the share program, it could really help your portfolio as far as a company buying back shares, giving the existing shareholders more value. It can also kill your portfolio, because as a company is selling shares, bringing in capital, that company is diluting the current shareholders. So you always have to see if a company is growing their shares, is the company growing the business at a much higher rate than the shares growing? If that's the case, you don't have much to worry about. But if it's not the case, it can kill your portfolio. You have to be careful. So they've been buying back a ton of shares, and they committed a lot of money in the future to do so. So we know this company is serious. They're not like some other companies who will announce it and not do it, like Palantir. But they are actually buying back a lot of shares, and they're continuing to do so. So when we get to the valuation, this is going to be really important. So we'll factor this in when we look at it. And I typically don't do that, but I think it's worth doing it here, since that's going to be where most of the value is going to come from as far as investing in this business. So PayPal right now, return on capital at 13% for the past 5 years. Average capital 8.9 as far as the cost of capital. So this company is creating value each year at a rate about 4.2%. It's a pretty solid rate. So as long as they have a return, you want high returns, but you also want to make sure their returns are higher than their cost of capital. Who cares about the returns if it's not exceeding the cost of holding that capital? So let's get to the valuation. This is going to be the fun part. So they've been growing their cash flows at about 20% a year for the past 5 years. I'm noticing in the revenues, we saw that revenue growth start to tail off, 8% down to 6%. So this company is growing their cash flows at a higher rate than they're growing their revenues. This means they're becoming more efficient, which is a good sign. But I'm going to make sure I keep that margin of safety there. So I'm going to estimate 6% growth for their free cash flow. Discount rate of 10%. If I buy this company now, in about 5 years, I believe I can easily sell it for at least 10 times free cash flow. Maybe more. And just to note, right now, they're selling at about 10 times free cash flow. That's where the price is right now. With those factors, this company, and based on my estimate, is worth $82.95. So we have an undervalued, established business right now that's adding a lot of value to the shareholders by repurchasing shares. About a 20% upside. So I believe right now this is a safe investment. I think that's pretty solid upside, especially in this current state where we have so many high value companies, so many overvalued businesses in the market now. I think this is pretty solid. Now, remember, they are buying back shares at a very high rate. So let's look at this real quick. For the past 5 years, they've been buying back shares at a rate of about 2.6%. For the past 2 years, they've been averaging about, I think that's about 5.5%, 6.7%. But remember, they are committed to buying back shares at about $6 billion per year for the next 3 years. So with that said, when I'm doing my valuation, I'm typically using the current share count, even though typically I'm investing in companies that are buying back shares. I know I typically do that. So as long as I keep the share count the same, even though I know the company is probably going to buy back more shares, that gives me another area of margin of safety. I typically discount the growth rate. I make sure my terminal value isn't too high. Make sure it's a pretty plausible or probable number. And that typically keeps me safe. And also the share count. Keep the share count the same, even though I know it's decreasing. But let's have some fun. Let's look at them in a few years if they continue to decrease their share count at half of the rate that they're doing it right now. It's going to be about 6% a year going on to 7%. Let's see where we're at. So if I do this for the next 3 years, I'll do 3 years. If they reduce it at 3% for the next 3 years, that $82 is now $90 a share, $90.88. $22 upside equates to 31.9%. So whether you consider the share repurchases or not, this company is undervalued, and it seems like to be a pretty safe investment. Now, when I say this, when I say $68 or $90 a share or $82 a share, that's not my price target. The price can do whatever. You can buy it tomorrow. It can go down to $40. Whatever. I don't know what the price is going to do in the short term. However, when the company repurchases shares, what they're doing is they're beefing up their earnings per share. So remember, when a company is repurchasing shares, what they're doing is they are increasing the earnings per share. The same earnings with less share means more earnings per share. This is one way companies add value to the shareholder outside of paying a dividend and outside of proper reinvestment with higher returns on capital. So this is great to see. Now, when it comes to the growth of the company, like we saw, looks like it's trending down. The growth might spur up again, it might not. What we do know is that they have cash flows to continue to add value to the shareholder. They're not interested in paying a dividend, but it looks like they're interested in really taking down the shares and increasing their earnings per share. So this is a great sign, and I think a pretty safe investment. So thanks for the person who requested this. This was fun to look at, especially, typically I don't touch the shares, but I thought it was important because seems to be the most important aspect of an investment into this company. So I hope you enjoyed this video and hope to see you in the next one.